Good evening, Dr. Kashin. Today, my group and I will be presenting our comprehensive case 3. The following are the group members. Yuvarina John, metric number 272656. Vivek Durgadini, anak perempuan Vigneswaran, metric number 272714. Vaiteswari, anak perempuan Murugan, metric number 272686. Aira binti Suhairi, metric number 272239. We will begin our presentation with Part A, Financial Assets. Question 1. Define equity investments and debt investments and explain which investment is better for the firm in the long run. When a company buys some other company's shares, it is known as an equity investment. It comes with a higher risk and thus a higher rate of return as well. When a company gives a debt, example loan, to another company using a debt instrument, it is known as debt investment. It comes with a lower risk and a fixed rate of return. In a long-term scenario, debt investment is preferred as it has a lower inherited risk than equity investment. Debt owners are paid first as debt has to be paid back to the company from which it was taken. Question 2. Prepare the journal entry at the date of the bond's purchase. At 1st January 2018, we will debit the investment in bond account and credit the cash account at the value 972,270 ringgit. This journal entry is to record the purchase of bond. Question 3. Prepare a bond amortization schedule through 2022. Round up your answers. Schedule of interest revenue and bond premium amortization is prepared for 10% bond purchase to yield 8%. So the interest is paid once every year, which is at the end of each year until maturity date. So the formulas for this schedule are: the amount of cash received is calculated by taking 10% of 900,000 ringgit, which will amount to 90,000 ringgit. This amount is consecutive for every year. The interest revenue is calculated by multiplying 8% of a carrying amount from previous year. The amortized amount is calculated by subtracting interest revenue of current year from 90,000 ringgit. The carrying amount of bonds is calculated by subtracting amortized amount of current year from carrying amount of previous year. So I'll explain for the year 2018. So on 1st January, the carrying amount is 972,270 ringgit. So for the interest will be paid at 31st December 2018. That will be the first interest revenue received. So the cash received is 90,000 ringgit. The interest revenue is calculated by multiplying 8% to 972,270 ringgit, which will amount to 77,782 ringgit. The amortized amount will be the result of subtracting 77,782 ringgit from 90,000, and we will get 12,218, which is the amortized amount. So the carrying amount of bond for 31st December 2018 will be 960,052 ringgit. This amount is obtained by subtracting 12,218 ringgit from 972,270 ringgit, which will amount to the carrying amount for the year 2018. So this step is continued till 2022. Note that at the end of year 2022 is the last date for the interest to be received. So there's an extra amount of 590 ringgit. So this 590 ringgit will be paid off as the final amount is 900,000 ringgit. Question 4. Prepare the journal entry to record the interest received and the amortization for 2019. On 31st December 2019, we will debit cash 90,000 ringgit, Credit interest revenue account 76,804. Credit investment in bonds 13,196 ringgit. Question 5. Prepare the maturity journal entry for the bonds at the date of maturity. At the date of maturity, which is on the 1st of January 2023, we will debit cash 900,000 ringgit and credit investment in bonds 900,000 ringgit. Question 6. Prepare the journal entries for the non-trading equity investment. On the 10th of February 2018, we will debit ordinary shares account at the value 2,400,000 ringgit and credit cash account 2,400,000 ringgit. This is to record the purchase of ordinary shares. On the 30th of December 2018, we will debit cash account at the value 60,000 ringgit and credit dividend revenue account 60,000 ringgit. This is to record the dividend received.
Hi, my name is Aira binti Suhairi. My metric number is 272239. So I will continue the presentation with number 7. As a senior accountant of SP, explain the disclosure requirement of 3 types of risks that may arise from financial instruments as prescribed in MFRS 7 Financial Instrument Disclosure. First, market risk. Second, credit risk. Third, liquidity risk. Part B, financial liabilities. Number 8, prepare the journal entries to record the bond issuance. 3 million need to time by 10% time by 6/12, so equal to 150,000. Maturity value of bond payable 3 million need to minus by present value of 3 million due in 10 years at 12% interest payable semi-annually is equal to 935,400. And present value of 150,000 interest payable semi-annually for 10 years at 12% annually 1,720,485. So the total is 344,115. The journal entry is debit cash credit bond payable. The amount is 2,655,885. Second is debit deferred bond issue cost credit cash amount is 150,000. Number 9, prepare the adjusting entry as of 31st December 2017. For 1st January 2017 is amount carrying a bond is 2,655,885. For 1st July 2017 is 2,665,238. For journal entry, debit bond interest expenses 159,353. Credit bond interest payable 150,000. Credit discount on bond payable 9,353. So the total is 159,353. The second journal entry is debit bond issue cost expense 15,000 and credit deferred bond issue cost 15,000. Number 10, briefly explain the accounting treatment for the retirement of the bond. It should be noted that if the bonds are held to maturity, any discount or premium will have been amortized totally. Only the bond payable will need to remove from the book by paying the face value of the bond in cash. If the bonds are retired yearly, any unamortized discount or premium must be written off as well as the bond payable, and the difference between the cash paid to retire the bond and the carrying amount of the bond must be recorded as a gain or loss on retirement. Part C, lease. 11. Assuming the SP agree to lease all the asset, prepare journal entries at the inception date. Excavator 225,000. PV of lease payment 161,880. Journal entries for excavator is debit lease asset, credit lease liability. The amount is 161,880. Concrete mixer lease payment 16,500. PV of lease payment 15,263. Journal entries for concrete mixer is debit lease asset, credit lease liability. The amount is 15,263. Dump truck lease payment 46,000. PV of lease payment 39,052. Journal entries for dump truck is debit lease asset, credit lease liability. The amount is 39,052.
Hi, I'm Vivek Durgadini and my metric number is 272714.
Today I would like to present about question 12, 13 and 14. So now let's see question number 12. For each of the assets, provide an analysis to determine the type of lease for lessor using the following schedule. There are 3 potential lessor and now let's see the criteria. Transfer of title is no for Harman Berhad, no for Armak Berhad and also no for Mendel Berhad. Content purchase option is yes for Harman Berhad, 75,000 ringgit at the end of 10 years. It is no for Armak Berhad and also no for Mendel Berhad. The economic life test is no for Harman Berhad because when we calculate we get 40% which is less than 75%. It is no for Armak Berhad too because we get 46.67% which is less than 75% too. And Mendel Berhad also no because we get 42.86% which is also less than 75% too. So now let's see the present value of minimum lease payment equals at least substantially all of fair value of the leased asset. It is no for Harman Berhad because when we calculate we get 78% which is less than 90%. It is no for Armak Berhad too because when we calculate we get 63% which is also less than 90%. But for Mendel Berhad it is yes because we get 121% which is more than 90%. Now let's see the type of lease. Harman Berhad is finance lease, Armak Berhad is operating leased, and Mendel Berhad is also operating leased. Here we can see the present value of minimum lease payment of Harman Berhad, Armak Berhad, and Mendel Berhad's calculation. So now let's see question number 30. Mr. Kiran proposes to issue bonds and with the cash proceeds purchase the needed assets. What might be the advantages of leasing the assets instead of owning them? And what might be the disadvantages of leasing the assets instead of owning them? So now let's see the advantages and the disadvantages. The first advantages is reduced risk of obsolescence. The second is less restrictive provision. The third is 100% financing. The fourth is decrease the cost of finance. Example is tax. The first disadvantage is lessee does not get the ownership of the asset, and the second lessor entitled to take over the asset if lessee makes a default in rental payment. Next, let's see question 14. Discuss the above situation. In your discussion, be sure to include what you determine about the lease and how you advise the company to account for this lease. Explain every journal entry that you believe necessary to record this lease properly, including the correction for the error made. Under all accounting standards, lessees account for lease either as operating or as finance lease, depending upon some complicated standards. However, lessees may find an impact to their business model due to new accounting standards of IFRS 16. Under new rules, the distinction between operating and finance lease is removed, and the lease asset shall be reported as a right to use like other assets, and lease rentals shall be reported as lease liabilities on the balance sheet. Furthermore, the new standards allow the lessee to charge depreciation on right-to-use assets, and any finance cost shall be charged either in operating or financing activity on the cash flow statement as an expense on the income statement. However, the lessor's accounting will remain unchanged from all accounting standards. Under full retrospective approach, it requires applying new guidelines retrospectively to each prior accounting period as required by IAS 8. Under this approach, lessees need to adjust beginning equity balance of the earliest comparative period reported. This is the calculation of present value of estimated residual value and present value of minimum lease payment. The first table here shows the calculation of beginning balance, lease payment, interest expense, reduction in lease liability, and ending balance. And the second table shows the calculation of the depreciation. Since the question never asks to prepare any journal entry, I'll use this way to explain every journal entry that I believe necessary to record. First is recognizing right of use asset and lease liability. The second one is restatement of the comparative period for year 2018. And the last one is the journal entry to make on January 1, 2019. That's all from me. Thank you.